Let me ask you a question. If crypto made so many people rich, why does it feel like everyone is still struggling now? Today, in 2026, crypto is no longer new. It's no longer easy, and it's definitely no longer forgiving. So the real question is not about, is crypto dead? The real question is, can you still make money in crypto in 2026? And if yes, how? So let's go into deep analysis and see if these methods will work in 2026. So let's get started. Let's start talking about the part of crypto nobody wants to admit they're here for. Meme coins. Whether people say it openly or not, this is where most newcomers believe real money is made. And to be fair, people do make money in meme coins. But here's the truth most videos don't tell you. Meme coins are not investing. They are pure speculation and timing games. There is no long-term value discovery here, and there is no fundamental analysis. So now I'll give you a live walkthrough of the deadly world of meme coins. As you guys mostly know, Pump Fund is a website that allows anyone to create meme coins. You can use it to trade these coins as well. So on the home screen, you can already see how crowded this place is. New coins are launching constantly and most of them look similar at first glance. This is important to understand. Pump Fund is not about long-term fundamentals, it's about speed, attention and liquidity. Most coins here will not survive beyond a few hours. Alright, first let's look at Kabuto. Kabuto is actually a good example of a coin that did something right, at least for a short period of time. If you glance at the stats, you'll notice a few things immediately. The market cap went into the millions. The trading volume picked up quite heavily. The bonding curve is already completed. And you can see that the coin has technically graduated. Now all of that sounds very impressive on the surface, but the real story shows up when you look at the chart. You'll see a very sharp pump early on, followed by a strong drop, and then some amount of stabilization. And this pattern is extremely important to understand. So what this tells us is simple. The people who bought early are the ones who made the most money. Anyone who came in late had to deal with much higher risk and a lot more volatility and much thinner margins for profit. So coins like Kabuto often look successful when you first see them. They look safe, popular and established, but in reality, by the time most people notice them, a large portion of the profits have already been taken. And this is a pattern you'll see again and again in meme coins. By the time a coin feels safe or looks popular, the risk to reward ratio is usually much worse than it was at the beginning. Alright, next let's take a look at Flying Explosion Device. This is a very new coin. The market cap is still low and the bonding curve hasn't completed yet. It's still in progress. Because it's so early, the price action looks extremely dramatic. Even a single buy can push the chart up very aggressively. And on the screen, it can feel like something big is about to happen. This is exactly where most beginners get emotionally pulled in. It feels like you're early, it feels like opportunity. But this is also the most dangerous phase. Liquidity here is very thin, which means getting out isn't always easy. One large sell can completely crash the chart in seconds. There's no real stability and exits can become very difficult if momentum disappears. At this stage, coins like this are pure speculation. There's no history to rely on, no structure yet, and no proven behavior. Just short-term momentum and hype. Now let's look at British Whale. At first glance, this coin actually looks very active. You can see a sudden pump, the chart spikes up, and for a moment it looks exciting, like something is happening here. But once you look a little closer, the picture changes very quickly. The market cap is extremely low, the volume drops off sharply, and almost immediately after the pump, the price collapses. There's no follow-through and no real support. This is a very classic trap pattern. Coins like this rely heavily on curiosity and fast emotional decisions, especially from the new users who are seeing the pump for the first time. In most cases, these coins exist mainly to provide exit liquidity for early wallets. And this is exactly where most users end up losing money. So don't panic seeing all this, it is doing exactly what it is designed to do. That's the reality of most of the meme coins. The platform always earns. Early creators and fast traders have the advantage. Late buyers carry most of the risk. If you're entering meme coins, treat it as speculation and not investment. Understand the mechanics before you touch the button. That's the reality of meme coins. If you feel this is too risky, if you feel instead of you playing the game is playing you, then there is another method with minimal risk. The most boring part of crypto, but ironically, the part that has made the most consistent money over time. Long-term investment. In 2026, long-term crypto investment is not about being early. That era is gone. It's about understanding cycles, managing expectations, and not self-sabotaging. Early crypto rewarded anyone who showed up. Modern crypto only rewards people who can wait. Assets like Bitcoin and Ethereum are no longer lottery tickets. They are closer to volatile macro assets. That means two things most people don't want to hear. First, the upside is lower than before. Second, the downside is more survivable if you're patient. This is where most people get it wrong. People come into crypto expecting faster returns, explosive moves, and overnight success. But it doesn't work like that. Long-term crypto investment works when you buy during boredom and not excitement, when you hold through uncertainty and not confidence, and when you measure time in years and not months. Most losses don't come from bad assets, they come from bad behavior. People buy after the story is already everywhere. They sell after the damage is already done, and then they conclude crypto doesn't work anymore. In reality, crypto still transfers wealth. It just transfers it from impatient hands to patient ones. Another hard truth, long-term investment in crypto is emotionally harder than trading because nothing is happening most of the time. You're forced to sit with uncertainty, and that's why most people fail at long-term investment. Not because they chose the wrong asset, but because they couldn't tolerate doing nothing. In 2026, profitable long-term investors don't try to predict tops and bottoms. They focus on positioning and time exposure. And here's the most important part. Long-term investment only works if crypto is not your emotional lifeline. If your rent, your ego, or your self-worth depends on price, then you will be selling at the wrong time. Long-term crypto investment isn't dead. It has simply become quieter, slower, and far less forgiving of emotional mistakes. But if you can handle that, then this is still one of the most asymmetric opportunities available. Long-term investment rewards patience. But what if you don't want to wait for years? That's where trading comes in, and where most people break. If long-term investing is about patience, then trading is about precision. And in 2026, volatility-based trading is still profitable, but only for people who understand what they're actually trading. Most people think traders make money by predicting direction. That's wrong. Profitable traders don't trade direction. They trade volatility, risk, and timing. Crypto remains one of the most volatile markets in the world. Large intraday moves, sudden wicks, violent reversals, liquidation cascades. That volatility creates opportunity. But here's the uncomfortable truth. In 2026, trading is no longer humans versus humans. It's humans versus systems. These systems don't care about your analysis. They care about where risk is concentrated. And this is why most traders lose money even when they're right. Let's take a closer look at this. Alright, this is Binance. This is one of the most used platforms for crypto trading. Let's start with the chart. This is a higher time frame view. But anyways, trading here is way less riskier since it's more like investment. But most people destroy their accounts here by zooming in too much. That's lower time frame basically. Now when it comes to trading, you'll notice things like moving averages and RSI on the chart. But let me be very clear about this. Indicators do not move price. They only describe what the price has already done. No serious system is trading indicators by themselves. What actually drives trades is liquidity, leverage, and timing. Now let's slow this down for a moment and look at what the order book actually is. The order book is not price prediction. It's simply a list of pending intentions. At the top, you have sell orders, and below that, you have buy orders. And these are not trades that have already happened. They're just requests to trade if the price reaches those levels. A lot of people assume that large numbers in the order book mean strong support or resistance. That's a mistake. Order book levels can be moved, cancelled, spoofed, or instantly filled and removed. So nothing you see here is guaranteed to exit even in the next second. Let me explain volatility in the simplest way possible. Crypto doesn't move violently because people suddenly change their minds. It moves violently because people are forced to act. When traders use leverage, they borrow money. That means, if price moves against them too much, their position is automatically closed. That forced close is called a liquidation. Most traders lose because they enter late, use high leverage, and place tight stops in obvious places. This is also why long-term investors survive where traders don't. Investors don't care about this noise. They don't sit inside liquidation zones. They don't need perfect timing. Trading demands precision. Investing demands patience. Confusing the two might be an expensive mistake. Let's say you don't want to get into all of these charts and risky trades. Then what option do you have? Let me show you. Mining is where crypto began. It's a part of the system that secures the network, validates transactions, and keeps the blockchains running. In the early days, people mined coins on laptops. Electricity was cheap and the difficulty was low. That era is long gone. Today, in 2026, mining is no longer a hobby. It's an industrial business. For most individuals, mining is not profitable anymore. Why? Because mining margins are thin and energy costs eat everything. Unless you have extremely cheap electricity, access to scale, and operational efficiency. Mining becomes a losing game. this is where many people misunderstand mining. They think mining is about earning free coins, but in reality, mining is about managing operational risk, cutting costs, and surviving margin compression. So mining didn't disappear, it professionalized. It keeps the network alive. In crypto, there are so many ways to make and lose money. In this video, I've not covered everything, but I've made sure to give you a deep analysis on some of the most used ways to make money in crypto. So that's all for today. Don't forget to like, share, and subscribe to our channel, and I'll see you in the next video. Bye-bye.